So first, before I get started, I want to just say a word about Wolfsberg Group, the institution that I'm here today representing. It's comprised of 12 of the largest G7 banks, including Bank of America, where I'm a financial crimes executive. And it was formed, the Wolfsberg Group formed in 2000 to establish industry frameworks and best practices for fighting financial crime. It's a flagship organization for the global banking industry on AML, CFT compliance. Some of you may know this group best for its due diligence questionnaires that we all use to help manage financial crimes risk. The group also publishes technical guidance and engages public policymakers on regulatory effectiveness. Some of its recent publications include one from last year, 2024, on effective monitoring for suspicious activity and principles for auditing effectiveness. Wolfsberg has and will continue to be an advocate for risk-based compliance and regulation, an absolute imperative in a milieu of dynamic policy developments and disruptive technology innovation, two topics about which this workshop has focused, and that have been the topic indeed of conference sessions throughout the whole of this gathering. So what are the dynamic and disruptive features of the financial crimes landscape today? The accelerating new threats, new criminal typologies, complex legal and regulatory expectations. I'll go through several of these, but I just want to offer that they all impact BAFT priorities, namely managing correspondent banking risk to protect systems while avoiding de-risking, advocating for AML-CFT modernization, and leveraging emerging technology, something about which I've heard lots of conversation here, while acknowledging how criminals misuse innovation simultaneously. So first, on these risks on the front line, we have new U.S. policy impacting money laundering. We've heard about that this afternoon in a number of occasions. Also impacting, of course, sanctions and fraud obligations. The U.S. administration has clearly identified its goals of leveraging economic statecraft to return to maximum pressure on Iran and, as so capably covered in the last session, destroying drug cartel revenue. It has embraced intensive and creative uses of sanctions and AML authorities to target terrorist organizations, to target individuals and firms, including the extension of the FTO sanctions to cartels, as discussed, and just last week, imposing special measures under the Patriot Act 311 authority on a Cambodian firm involved in crypto investment scams. Some of you may have seen. Now, tracking terrorism and cartels is fairly well-trod territory for banks in an AML program, but this administration's new alerts, including emerging financial crime typologies, they're coming at us fast, and the stakes are going up. The legal stakes are going up. A second risk I want to highlight is jurisdictional divides and what I'll call a regionalization of regulation and enforcement. This stems from a couple of driving factors, but a degradation in transatlantic relations and cooling efforts to align the sanctions policy. That's sort of a polite way to describe the movement in different directions by the major transatlantic jurisdictions. There's also reform efforts afoot for AML policy on both sides of the Atlantic that address similar themes, but are in no way coordinated, contributing to the tension or the friction and regulation across jurisdictions. Moreover, a backdrop of a trade war, which I need hardly remind you about, and corresponding shifts in trade flows present a unique and somewhat underappreciated, in my view, financial crime challenge. AML and fraud experts will need to spot tariff evasion. We heard a little bit about that this afternoon. Tuning fraud or TBML tools, detection tools, and analytical capacity to catch this additional challenge in the cross-border trade space. So alongside these risks are rapid technology shifts that enable criminals to defraud and steal with alarming speed. None of us are immune to fraudsters spoofing our support telephone numbers masquerading as our staff or swindling our customers, unfortunately. Social media helps romance scams proliferate by lending credence that the paramour who needs $10,000 to make a killing in Bitcoin is a real person. And digital assets have made moving the proceeds, especially across borders, far more efficient. So with these various risks in mind, I want to pivot now to talk about the intersection of financial crime risk with global commerce, and then talk about how we respond with concrete proposals. And I'll invite your input with polling questions. As financial institutions, all of us here who run the rails of global commerce through correspondent banking relationships, trade finance instruments, or advice and facilitation of investment, we have always been concerned about criminal abuse of global trade, sanctions evasion, for example, trade-based money laundering, and more recently, tariff evasion. We know that government authorities, particularly the US government, concentrate their enforcement on third country sanctions and money laundering risk associated with high-risk jurisdictions. Sanctions designations in well-known transshipment jurisdictions draw our attention to the illicit finance vulnerabilities associated with our customers' customers and our affiliates. The UAE, China, especially Hong Kong, have been a particular focus for sanctions designations, and they're also of particularly elevated risk for money laundering and shell company activity. I need hardly tell people who are in the business of correspondent banking. Reflecting on precedent, the Biden administration focused on hunting for illicit Russian procurement of battlefield items through a web of shadowy banking activities. This included significant scrutiny on those same jurisdictions that I was just noting. More broadly, and as a compliance methodological point, the US government urged financial institutions to marry trade, customs, and financial data to find Russian sanctions evasion. You may recall the US Commerce Department issuing a specific advisory letter to financial institutions about their obligations to support export control evasion. That was a unique first. We have passed the 100-day mark now for the Trump administration, and the new political leadership appears set to build on that Biden playbook for merging trade and financial data in how they target illicit finance and expect bankers to look for this activity. The new administration also appears to be focusing on the intersection of fraud and money laundering with the new targeting. That Cambodian example I just mentioned before is a good example. Importantly, even in an era of regulatory tailoring, that's a phrase that comes from the Federal Reserve, as you may know, used to describe the streamlining or cutting of regulation. Political leaders will ask us to do more to detect criminal networks and their illicit financial footprints. They want us to use more data to find illicit finance, and they're serious about destroying drug cartels. They are serious about, and I'm quoting here, making Iran poor again. And they are already asking us to be on the front lines of this campaign. So on top of these heightened expectations about sophisticated investigations, there are additional considerations. These include investment restrictions, inbound and outbound, and supply chain integrity concerns. So some questions that are forefront in my mind, perhaps some of you too. How will regulators expect us to overlay various compliance obligations, not all of which fall in financial crimes? Do our banks have the right expertise, the right routines to work cross-functionally in our jurisdiction, in our institutions? How do we navigate the expectations of multiple jurisdictions? How do we prioritize our spending to implement the innovations we need to respond to regulator expectations? What kind of information sharing do we need to understand when we are on the right track and advancing the national priorities? Before turning to how we should address these financial crime challenges, now I'd like to gather your feedback. Do you agree with what I've just said? Do you disagree? And how are you addressing it in your institutions? So if we can pull up the first question here. Yep, here we go. Uh, just reading this out here as you're thinking about it, which of the following trends presents the greatest AML concern? So far, no voting here. Okay. Loading. Excellent. So the first one here, this is a third-party professional money laundering, including Chinese money laundering. This is interesting to me to see. I was wondering if fraud would get a stronger showing here. Yeah. It's happening. Yeah, there's no wrong answer here. These all being concerns, some of which are linked. Okay. So that was the first one. Let's move on to the second one here. I appreciate that. I'm making a note. How do you discern, how do you look at the administration's illicit finance priorities? What are you looking at when they are communicated? So of course, here we have the formal FinCEN AML CFT priorities published once 4 years ago. We're hoping that those get published again statutorily this year. Public statements by administration officials, the priorities, law enforcement. I just want to note for people while you're looking at this, I regret that Magali Langhorn had to leave from the earlier panel, if you recall, sitting here moderated. She was talking about the necessity for financial institutions to look to priorities. She gave a couple of examples. Actually, could we bring the poll results back up again? Thank you. The question I would have asked her had I had the time, I know her, so I will ask her another time, is for examiners, what are you looking at? Because I'm interested to know what financial institutions are looking at here, but examiners have their own ideas about what meets threshold and what doesn't. And she threw out a whole lot of examples, which include these and go beyond. But this is interesting to me to know that amongst the denominator of people voting, we have a little bit more attention to public statements by administration officials. Right now, given that we haven't had a republication of the AML CFT priorities since 4 years ago, I'm in the same camp as the 50% people who voted here, but noting we're examined on all of them. So the next question here. What are your biggest challenges in leveraging external information for AML investigations? While you're thinking about this, I would just offer, I noted when I gave some opening comments at the top that we are expected by examiners and policymakers to use not just internal data, but external data. Indeed, that can be essential for blockchain analytics or attribution. It can be essential as we're trying to figure out some of the networks involved in sanctions evasion or network mapping. But there's challenges with all of them. So our leading indicators here appear to be cost and difficulty of onboarding external proprietary data. I'm certainly in that camp as well. Quality of the information, that's very interesting. Okay. Thank you for that. Just bearing that in mind, and we'll move on to the next one. What's the highest spending priority for your AML compliance program this year to address the dynamic risk environment? So I'm using this question, by the way, as a proxy, imperfect as it may be, to get at how you're running operations to drive at the most important AML challenges that you face. This is interesting here. So technology is our winner so far, which may be both a comment on the priority for spending as well as the cost. Okay, let's move to the next question, which is my last here. What would be the highest impact law enforcement feedback for your institution? So I hope this question makes sense. And the reason why I'm asking this is because there's not a lot of feedback besides, of course, some of the examiner guidance that financial institutions get about what they're doing right, how they're effectively examining against priorities issued by government. Okay, here. And sometimes we'll get feedback from law enforcement directly, it's private. And investigations will get thank you letters. Responses on individual BSA filing specific SARs, we rarely get feedback on that, speaking from my own experience. Okay, so here again, most people are looking to the first one here. Okay, I think we will now move on, and I want to talk a little bit about responding to the challenges. There are several activities that I think should be among the highest priorities in amongst our responses, and they include, unsurprising to you, I hope, additional detection and analytical work on some specific risk types. Also, rethinking the human capital and technological infrastructure of our compliance programs. And finally, we need to make clear how the supervisory and examination framework can best support us. A top priority now is focusing on third-party risk and precisely what robust, high-quality due diligence must be on the part of our correspondents, affiliates, vendors, and clients when their activities could introduce illicit finance risks into our own systems. Regulators have increasingly raised third-party concerns to us and take the opportunity to beat this drum as often as they speak publicly, in my experience. As an example, industry needs to be particularly careful around third-party payment processing, we are often reminded, and note, which is a challenge underscored in this moment of regulatory divergence and as stablecoin payments become more mainstream and as new trading entities and commercial flows emerge as a result of the tariff landscape. Do our affiliates and customers and do customs brokers and import-export firms know how to manage this risk? What does that mean for larger financial institutions? The right response to this is at once both simple and complicated. It's simple because it comes back to fundamental due diligence and monitoring. So basic block and tackle for your program. Complicated because some of the payment platforms and financial flows and illicit typologies are so rapidly evolving. A second priority response to financial crime challenges is to take an approach to financial crimes compliance that is multifunction or cross-disciplinary. To be AML experts in a traditional sense is no longer enough. Today, fraud schemes are as much a cybersecurity concern as they are a financial crimes concern. In that context, our relationships with telecommunications and social media companies matter just as they do with our law enforcement and financial institution AML counterparts. I think this point was really ably made by the title of the last session. I think it was just before lunch in the main session, talking about the intersection of some of these areas. So internally, we need creative and nimble workflow practices and updates to our procedures and routines to leverage broad forms of data and expertise to deliver effective results. In addition, if we acknowledge that financial crime risk is increasing and becoming more varied, then we need to be held against a true risk-based standard. There's no room in this challenging environment for a staid regulatory focus that prioritizes compliance architecture over proactive threat analysis and network mapping. We need to be clear and consistent in saying this. There's an important strategic point underlying what I've just said. So we know the principles for a true risk-based approach. AML programs in major financial institutions know those principles. Industry must be vocal in moving the entire sector with all of its stakeholders in that direction. So how do we do that? Certainly, the new US administration has promoted an overhaul in regulation to update how we are governed under the AML rules and procedures. We have a strong role to play, we as industry have a strong role to play in making sure this can indeed occur and that our voices are heard in this process. The administration has been open and explicit on this point, and if we want risk-based supervision and examination, we should help clarify what we see as the roadmap for revising the framework. But that's only one stage. The second is the administration providing us as industry specific guidance on AML compliance and incentives so that we run our AML programs to detect and disrupt today's greatest financial crimes threats. What are the most concerning criminal typologies? We might fairly ask of our regulators and policymakers. What are the government's financial crime priorities now, noting that they haven't updated the official national priorities in 4 years? How many times in forums like this one have people lamented that the official FinCEN AML CFT priorities are aging or lack focus to meet the moment? To truly have a risk-based compliance and supervision, we should be graded on our ability to disrupt the most concerning illicit finance threats now, of this day, threats we need Treasury's guidance on. So to that end, we also need significantly more information sharing, broadening it globally and increasing efficiency. We have examples in the US context that work well. The Patriot Act 314 processes and FinCEN exchanges facilitate the sharing and can prompt us to do deep network analysis that catches the most significant threats. We need the support of authorities. Why should we accept that this paradigm cannot be expanded globally? Why should only a handful of countries work together when the criminals are leveraging their global footprint and economies of scale? Practical examples are there, but more good ideas, like the pilot program for SAR sharing with overseas subsidiaries and affiliates, must be increased and embraced by regulators. So I'm going to conclude now with a reminder that because we sit at the front lines of financial crime, we have a tremendous amount of responsibility. We also see tremendous opportunity in how much we can bring to that fight. If we're clear in articulating what is an enabling environment for significant action, and if we are prepared to support and encourage our industry peers and authorities to make that a reality, we can answer the challenge of the current environment. Thank you very much. I'm happy to take any questions and welcome an open discussion.
Question. So earlier during the panel, this was in the morning, I'm not sure if you were here, but we talked about challenges when it comes to like global organizations dealing with different regulatory regimes across different jurisdictions, right? From the Wolfsberg perspective, I know that's one of the objectives and goals is the harmonization. Do you have any stats or data or maybe just qualitative case studies on how Wolfsberg has assisted in moving that kind of goal objective forward?
What a good question. Thank you. So I think it's real, the friction that multinational jurisdiction institutions have coping with differentiation and regulation. So one of the most obvious ones would be sanctions. It's obvious because lists either match or they don't match. End of story, right? So although on the one hand, it's not that hard mechanistically to program into your sanctions screening legal entity, which is to say a code for the jurisdiction and applicable list. And then it sort of runs mechanically. Where it's more difficult to discern is where there are different standards or requirements, like how fast you have to screen your sanctions, in what time period. Europe is different than the United States, and the guidance and the requirements that they have, that's a challenge. So if you're running enterprise operations and have to build to a standard that you can work across the entire of your enterprise, that's really difficult. So Wolfsberg as an institution will talk to different regulators about about the purpose of what they're doing, and then offer back feedback on what that looks like mapped onto a large institution that is multinational. So that may have to do with payments, real-time payments, or payments screening. It can also have to do with the way that other AML obligations occur. So right now, as the EU is revising its AML framework, is a good opportunity for Wolfsberg to put together response comments and bring that to the to EU legal authorities. The same will be true for the US jurisdiction as well, where there is, in this deregulatory moment, or milieu, at least per the rhetoric, an interest in revising the fundamental rule underlying AML obligations in the United States, the AML program rule. So those are some of the things that Wolfsberg does. And having been on the other side of this, I don't know how many of you are familiar with, if you read my bio or saw this, but I come to industry now from the US Treasury Department, where I was on the policy making side of the equation. And I received visits from different financial institutions who wanted to explain what it looks like in practice to have regulatory expectations that do not match. I don't think that's evident, and it's impossible to foresee in certain circumstances for regulators who don't necessarily appreciate, no matter how well-intentioned and regardless of how much research they do, what the implications will be when there is a friction. And it can have significantly unintended consequences, which makes it imperative that we have financial institutions go and talk to regulators. It's easier sometimes when that happens as a group in an industry association.
Great point. And Magali was making a similar point in terms of being on the other side of the equation, from going from examiner to seeing the bank side.
Yeah.
Appreciate that. Any other questions? Okay, well, in that case, thank you very much. Really
Thank you.
appreciate. Please join.